I really want to focus on the mega cap tech comments. What did you think?
Well, I didn't hear the full comment from Carl Icahn, and I think it's a little bit rich to say who should or shouldn't be running companies when some of these companies are founder-led. But what we do see with the job cuts at Meta yesterday, for example, is that tech is moving through the same three-phase restructuring that we had long expected, which is the first phase is to cut all these crazy flight of fancy projects like balloons and drones that provide internet service. The second is to grind out productivity enhancements, and now Meta's fired, I think, 21,000 people. And the third will be for the companies that really face a survival issue to look at absolutely every cost they have and possibly have to, think in terms of survival.
Okay. So he was talking specifically about valuations. I'm going to just kind of fill you in on some of the other things he was speaking about. So let's focus on Meta for a second. On Meta-led communication services yesterday, it finished up more than 7%, trading at about 20 times forward earnings. So in your mind, someone that looks at these stocks, is that too rich? Is that too high of a valuation for a company like this that has, number one, a very strong business and consumer base, and also the potential, if some of these things take off, to really explode?
Well, before we talk about the potential for something to take off like the metaverse, which is clearly sometime in the future, our issue with Meta, and we have it rated as a sell right now, is that the valuation has become too rich. And if you look at the estimates for the second half of the year, the street is expecting 9% or more sales growth. And while there are going to be some easier comps by the end of the year, I don't think the company would be cutting staff in a second wave like this if they saw that same rosy outlook. And the problem with a lot of these tech stocks is simply that the E is wrong. The earnings estimates are wrong because the street is perpetually too bullish on these names.
All right, fair point there. Also want to look at Microsoft, obviously in the news a lot due to ChatGPT and its OpenAI investment, trading at about 26 times forward earnings. So is that valuation too high?
Again, Microsoft has a bit more of a durable franchise in that it has recurring revenue as opposed to reoccurring campaign spend that Meta tries to pull in from advertisers, and they're less exposed to the demand destruction that happens when advertisers pull back their spending. That said, we look at tech stocks generally, and the valuations are still pretty punchy, especially given the higher interest rate environment Carl Icahn mentioned.
All right, so if you think that's punchy, I'm looking at Amazon right now, trading at 65 times forward earnings. So if 26 times was punchy, what's Amazon at 65?
Well, look, I think you have a whole category of companies that have, they're above the stratosphere. They're kind of in the troposphere, and you can't shoot them down because they have a business model or a story long term that people back and have faith in. If you look at, you throw up Alphabet or Apple there, they are companies that generate substantial levels of operating cash flow, and in the case of Apple and indeed Alphabet, they buy back a huge amount of their stock. So Amazon doesn't have the support that Apple does because there's a buyer of $80 billion of Apple stock in the market every year, and that's Apple. They're recycling that cash flow back into its own stock, which creates some support. Amazon, I think, is uniquely exposed to a slowdown in consumer discretionary spend, which is one of the big risks in the market right now, very clearly.